Hi, I'm Cathy McBreen, president of Millionaire Corner, and we're delighted today to have an investment manager just talk to you about what's happening in the fixed income market. I'd like to welcome Aaron Izenstark. Just so you know, Aaron is the co-founder and chief investment officer of Iron Financial. He's responsible for the oversight of Iron's investment management, research, and trading capabilities, and for the oversight and management of the firm's approximately $1.9 billion. Prior to co-founding Iron Financial, Mr. Izenstark was a member of the Chicago Board of Trade and the Chicago Mercantile Exchange, where he specialized in the trading of fixed income and equity derivatives. Welcome. We're really glad to have you here. It's nice to see you.
Yep.
We have a few questions for you today. First of all, could you talk a little bit to our members of Millionaire Corner about what is actually happening in the fixed income markets today? There's a lot of talk about quantitative easing and the tapering. Can you explain what that really means?
Sure. There's a lot of concern, obviously, given over the last 5 years, what's happened as the Feds had to intervene in the market and actually go in and purchase securities to prop up prices, which lowers interest rates. And so the concern is as the Fed slows or stops buying these securities, that interest rates may go up a little or a lot. And we believe that there's probably a balance in the middle where artificially they've been flooding the market with money, which means they're buying securities. That there's probably a good chance, and it looks like it's already started, that interest rates will inch up as a huge supply-demand shift changes when the Fed slows or stops buying securities. Right now they are predicting that it will probably end sometime in the middle of next year.
So can you explain, a lot of people, it sounds like, are getting out of fixed income, and is that the appropriate strategy for right now, or are they ahead of the cycle, or what should people be thinking about right now?
Well, there's two definite issues to really ponder. If you put money in a money market, you essentially get zero right now, which nobody wants, of course. And if you go out long term, your risk is significant in the fixed income market. Let's just say if you buy a 10-year duration security in the market, interest rates rise 1%, you're looking at a 10% loss in your security. So that's a little difficult to make up in the fixed income market. So right now, there's a significant amount of selling that's happened over the last couple months in the mortgage-backed security market and the municipal bond market, especially on the intermediate to longer term, so 5, 10, and out. And that's a troublesome spot because if interest rates do start to rise, which they've already started to inch up, there's no real protection for the average bond investor in a general bond fund, whether it's a mortgage-backed security or a municipal bond fund, to get. So the only thing that they do naturally is sell to stop the losses. And I think what happened after the second quarter is you probably had a significant amount of investors open their statements to see some of the worst bond performances in 20 years. And it's unsettling because they thought, okay, someone who told me to go into this, or I looked at myself, it looked like it was yielding a decent yield, but then I just lost 3 times as much as I could make all year. And so I don't like that, so I'm selling. And but the opposite is really not a solution either, because sitting in a money market, you're getting zero, which doesn't really help investors either.
So talk a little bit about, should investors right now be looking at yield, or should they be looking at the duration?
I think first duration, because duration is the measure of risk in fixed income. And essentially, if they only look at yield, you're missing 2 pieces, which is sometimes a misconception in fixed income. It's not only interest rate risk, you have to look at credit risk, and they're 2 separate animals. And the credit risk is the quality of a company. So you can have, it could be a low quality company with a very short bond life, and you think, oh, I'll just wait till it matures, but if there's a default risk in it, that's what credit risk is. Interest rate risk, of course, is how long you have to wait for that bond to mature and what the fluctuation happens in between. So we prefer to recommend people focus on short duration right now, because short duration will give you that balance of yield and also interest rate protection.
So what is a short duration bond?
Typically somewhere between 2 to 3 years.
Okay. And should they be looking at corporate bonds, or should they be looking at municipal bonds or treasuries? Or when you say bonds, it's sort of a big...
Yeah, the average investor right now should probably have a mix of a little bit of everything. Right now it's a little easier to invest in municipal bonds in probably a short fund, because to get proper diversification in a ever-changing municipal market, especially when you've had Detroit that just filed for bankruptcy, and some of the other problems that we're having here in Illinois and with Chicago bonds, you don't want to buy one bond in your portfolio. So there's short duration funds out there that you can buy that have 2 to 3 year durations, and you have a significant amount of diversification. In the taxable market, we do like corporate bonds right now. We like both investment grade and also below investment grade. So investment grade are typically going to be high quality securities. And again, in that, the sweet spot is somewhere between the 2 to 3 year duration right now, that allows you to get some yield but not take too much interest rate risk. And if your bond portfolio is big enough, you can create a portfolio that has a diversified set of bonds in there, sector and credit neutral, that allows you to have all different sectors and be pretty diversified and create some kind of a ladder. So if interest rates do rise, you have bonds coming due at the same time you're reinvesting in higher rates.
Should the average investor try to buy individual bonds, or should he or she really focus on bond funds?
If they're doing it themselves, it's probably a difficult task, because because we live in essentially an electronic age right now. It's either when something changes and changes drastically, there's no time to make that adjustment. So someone has to be watching these bonds for you before, and as things start to deteriorate inside the company itself, it makes sense to then make a change. And so if you're going to buy a portfolio of individual bonds, it probably takes a professional to do that. There are people that do try to do it themselves, but essentially what they're going to do is going to wait till something happens and then try to make a change, and it's too late. So I think for the most part, if you stick with short-term bond funds for the individual investor, it's probably the easiest, although again, you can find there's plenty of portfolio managers out there that can create a portfolio of individual securities for you that would probably make sense too.
Can we go back to quantitative easing for a moment? Can you explain what the difference is between, from what I understand, there are a couple of scenarios that will or could happen, and one is obviously that the Fed stops buying back its own bonds, and secondly, the interest rates go up. How do those two things work in tandem, and which is the most likely to occur first, or do they automatically occur together?
It is something that will probably work in tandem, meaning that as they slow, it's a supply and demand issue. There's less demand in the marketplace. And the other factor is people start getting nervous to see what's going to happen. So that creates less of a demand, because the investors step back to see what happens. And it's also natural for an investor to say, well, if interest rates are going up, maybe I can hold off and they'll be higher when I want to buy a security. But there's a significant amount of tapering or less buying that needs to happen over the next year, and it's likely that it will be done in time. And we've already had probably in May, June area, some significant rise in rates from the bottom of the 10-year Treasury was around 162, and it got all the way up to 280, and then settled at the end of the quarter at about 260 something, and now it's again close to 290 again. So there's some real volatility in there. And again, if you invested in a 10-year security that had a 10-year duration and rates went up 1%, you lost 10% of your principal. And it's a long time to wait for that to come back as an investor to say, oh, now if you go out and sell it, it's a mark-to-market security. So typically staying short duration usually makes the best sense.
So do you anticipate some of this will start happening in September?
I think it's the market always anticipates. So you just had it happen in the last probably week here. We've had rates little by little rise again, and if they do start the tapering, I do think you will see a continuous slow rise in rates, and maybe not to where the rate bonds were in the 80s or 10s or 15%, but I think it's likely that it will because you're taking $1 trillion buyer out of the market, and so there's a natural level that the market will seek to where it makes sense.
Well, Aaron Izenstark, thank you so much for sharing your knowledge today with our investors. If any of you have any additional questions, go to www.ironfinancial.com. Thanks so much for watching.